Thank you for everyone making the time to be on this webinar. As we take a look in the year ahead for 2023, I've gathered from a lot of people that are smarter than me just kind of where the housing market should be going, and it's important for us to communicate that to our sellers and to communicate that to our buyers. So in the fall of 2022, we saw interest rates rise very, very quickly and hit 7%. And as we head into as we're in the first quarter of 2023, we've actually seen interest rates dip. So let's get right into it. If you guys have any questions at any time, let me know. I'm super happy to answer anything and everything. There's my contact info. Feel free to email me, call me, text me. I'm available 24/7. So let's get right into it. Inflation is a very huge driver of mortgage interest rates. Now, there's a lot of different inflation reports that the Federal Reserve, takes a look at, investors take a look at. There's the CPI, Consumer Price Index, and then there's the PCE, Personal Consumption Expenditure. What a lot of people take a look at is the CPI report. So you can see right here, interest rates very heavily follow the Consumer Price Index, the cost of goods, eggs, the cost of buying a car, the cost of shelter, housing. So you can see right here, back in 2018, going back to 2018, we had inflation starting to come down. Now, right here, this QE period means quantitative easing, meaning that the Federal Reserve was buying mortgage-backed securities. And as you buy a certain bond, the yield goes down. There's more value. The price and the yield goes down. So you can see that the feds were saying that inflation was transitory, and they kept interest rates at 3%, even with inflation going up very much. So in transitory, they were saying that inflation is short-term, it's not a long-term thing. So they held this on for too long, and you can see inflation absolutely shot up. And as we have gotten more inflationary data through the most recent months, we're starting to see inflation slowly start to come down. And you can see interest rates have followed suit as well. Now, what does that mean kind of moving forward? The ultimate question is, when will inflation peak? You're having buyers right now that are on the fence saying, well, we're going to wait to sell our home until interest rates come down, because when you sell your home, you're going to have a replacement property, right? So what this takes a look at is, this is the core consumer price index. It takes out volatile food and energy. Energy, like OPEC, can control the amount of gasoline that's going out, to the public. And then when it comes to food, that's more dependent on weather conditions. So we strip that out. So this is really what the feds are taking a look at, is this number right here. So if you take the last 12 months, that's a 5.7 reading. That's the inflationary reading as of right now at this moment of time. In December, we had a 0.3%, and that replaced a 0.6%. So we dropped from 6% to 5.7. So as you can see, we've actually seen inflation start to come down. Now, a big driver of inflation, like we were talking about, is shelter costs, the cost to have a roof over your head. Now, this number right here, and this is a national level, guys. This is the year-over-year increase of home renting, owning, and you guys can see here at 4.6%, this is a lagging indicator. When you have a lease agreement, that lease is locked in for 12 months. So this is a lagging indicator because it's taking in consideration months that maybe the leases haven't been renewed. And you can see, guys, that this is the real-time number, but this number for CPI for shelter hasn't caught up. And why I want to stress on the shelter part, guys, is that makes up 39% of the CPI report. We've already seen food and gasoline and clothes start to come down in the CPI report, but what we haven't seen come down is the shelter costs. And just like a roller coaster, guys, right here, this real shelter cost, that is this number here. But what about the numbers that the CPI is taking into consideration? That's a lagging indicator. So as shelter, is back here, when we start to get past January's numbers, we're really going to see the consumer price index drop even more. Like I said again, guys, shelter costs the cost of housing to rent your home. What does that cost? It is a lagging indicator. This is obviously real time. This is the reports that they're getting. And after January, you're going to see that decrease. What happens when inflation decreases? Mortgage rates decrease. So I want to show you guys, let me actually move this right here. What I want to show you guys is the spread between different coupons, right? So this shows the last 30-year fixed mortgage, the spread between a 30-year fixed and then a 10-year treasury. So a normal spread, guys, right here is about 175 basis points, or in super layman's terms, 1.75% to 2% spread. So if you go on right now, cnbc.com, you'll see the 10-year yield. How does that affect mortgage interest rates? It's a very similar indicator. So you can see through time, yes, there's a give and take, but it's about 175 to 200 basis points. Well, we got to the fall of 2022. A big driver of why there was such a spread is the value of servicing. So all mortgage lenders sell to the secondary market. Now, when you make a payment to Loan Depot, Wells Fargo, Mr. Cooper, that is not the investor, that is the servicer. They get money to service that loan, to make your mortgage payments, to disperse your taxes, to disperse your homeowner's insurance. Keep in mind, that investor is getting that interest for a 30-year fixed loan. Typically, people do a 30-year fixed loan. Well, as the servicing value decreases, the cost to service that loan goes up because the servicer believes that that rate at which the borrower locked in that rate is going to refinance before there is even a moment of them getting an investment. For example, when interest rates hit 7%, a lot of smart money believed that those rates weren't going to stay that inflated forever. So the cost to service that loan became higher. So that's why we saw more of a spread, and we're actually more of a spread right now. When we start to see inflation come down, when we see this 10-year treasury start to come down, you're going to see the spread on the mortgage rates come down with it. Would you rather service a 7% loan or a 6% loan? You're going to do a 6%. Would you rather service a 6% or a 5%? The lower the rates go, guys, the more the servicer feels like that they're going to be in that rate longer. And a lot of smart money believes that interest rates are going to come down. That's why there was such a spread to mortgage. Hopefully that makes sense. So this spread is narrowing, and we can see different peaks and different valleys, but as that spread starts to come down, you'll actually see interest rates come down. Now, guys, a recession is coming. This is a really important slide. So what you can see right here is the amount of credit card spending in real time right now. And this is in billions of dollars. And right here, we had the stimulus money go out. And when the stimulus money, came out, people were using that cash. As the cash has gone away, you're seeing people still spending, even though their savings have gone significantly down. We saw the recession hit in 2020, stimulus bill. Everyone had a ton of money in savings. That's why you saw people putting money in stocks and meme stocks. They had disposable income that they could invest that money. That's why the stock market went super inflated. So as you can see here, and this is another stimulus bill and then another stimulus bill with the child care credit. So as the stimulus has run out, guys, you can see savings is actually lower than it was pre-COVID levels. But people haven't changed their spending habits. And that is the problem. And why I want to bring this up to you right now is because I believe you're going to see the stock market come down. But what happens during recessions? Interest rates come down. And with such a lack of supply of inventory, you're going to see home prices go up because interest rates will come down. This is another example of why a recession, the problem with the recession, guys, is we don't know we're in a recession until about a year later after we get the data. But we are in indications right now that we are currently in a recession. So let me show you this. The 10-year yield minus the 3-month yield. If you were going to invest your money today, you think that you would get more money to invest that for a longer period of time, right? You're going to park that money away. I need a better investment. That's not the case right now. You can actually get a better return to invest your money in a short-term yield, like a 3-month yield versus a 10-year yield. That's a sure sign of a recession. And let me show you how that's followed suit. So if you take the 10-year yield right now and you subtract that to minus the 3-month yield, we actually have a negative number. And you can see through time that every time we've had a negative number, recession, negative number, recession, negative yield, recession, negative yield, recession. We are definitely in a moment where I think we are currently in a recession. And I don't mean that to scare you guys. I mean that to show you that it is a great time to think about investing in real estate. It's a great safe haven against inflation. Hopefully that all makes sense. If you guys have any questions, obviously let me know too. Here's the thing, guys. We are in a situation where we have such a lack of inventory. You have clients right now that are thinking about selling their home, but they're in a 2 or 3% interest rate. Why would they want to sell their home to go then buy something that has less square footage that's costs more with higher interest rates? Those people probably aren't going to sell. And that's going to cause a more shortage of the amount of housing that's available. And when there's a shortage of housing and interest rates come back down, you're going to get more demand. So this is showing household formations. What this means, guys, is let's say you have a son or daughter that's becoming of age. They're going to want to go buy their next home. 30 years old, 30 to 36 years old, they're going to want to buy a home. And that's causing a new household formation. So we can see here, guys, that we have about 1.3 million people as of right now that are becoming of age nationally looking to purchase their first home. Now, with housing starts, in 08 and 09, we had a surplus of housing. There was too much inventory. So builders are becoming a lot more wary of that in this moment of time. So they're not starting as many new builds. Let me put that in layman's terms. 2 different types of properties. You have new builds. Those are new homes, like new developments. And then you have a resale. Resale is like you have your home today that's just reselling. It's not a new build that's being built. So housing starts being complete about 1.5 million. This 100,000 is what houses just deteriorate over time and they get rid of those. So you have total new household supply of 1.4 million with a household formations of 1.3. So a little bit more inventory that meets the demand right now. Like I said, builders are cautious just because of what happened during the housing crisis. I want to put this in perspective for you guys, and I want you to show this to your sellers and I want you to show this to your buyers. But everyone in the media is talking about a huge recession, a huge price correction. But when you look at homes from the last 10 years, we're actually up over 115%. And as interest rates hit 7%, we actually peaked. We were only down 2.5% for home prices we're at in the months prior. So obviously since COVID, we saw appreciation shoot up, about 40%. So we're only down about 2.5% right now. Let me talk to you guys about affordability today. I'm going to put this in super layman's terms. So this time last year, your buyers could borrow a $400,000 loan amount at 3.5% interest rate. This would be their payment. Now, a household income, if you take everyone's household income and divide that by 12, on average, it's about $9,000, right? Again, this is on a national level. My people in San Diego, obviously, we know this is going to be a little bit higher. This is just to put in perspective. Well, this year, with a 10% appreciation, that loan amount now is going to be borrowed at $440,000 with a 6.25% interest rate. Now, that increase in payment is $913, but that doesn't tell the whole story. Your client also is getting a pay increase at their current job. Let me show you guys all. If you were at your current job, if you had a client at your current employer, they made about 7.6% more than they did last year. If they switch companies, they made about 15.1% more. And on average, it's been about a 9% increase in their wages. So we can see that increase of wages, $810. Now, housing is just one piece of that consumer price index. You got to pay for gas, food, a maid service. There's different services. So that's also increased as well. But if we take a look, guys, moving forward in 2023, if there's only a 5% increase income pay, we're going to show $1,300 more than they made, last year, the year before prior. So with that increase in pay, guys, if we're looking at it for this year, a lot of people believe interest rates will hit 4%. You're going to probably stay flatlined as far as appreciation goes. So you're borrowing $440,000 at 5% interest rate. Yes, that payment is higher, guys, but your income is substantially higher. And it's actually more affordable to buy a house now than even when interest rates were at 3%. So again, I want to put that in perspective for you guys. Obviously, when you have a job year over year to keep up with inflation, you're going to receive pay increases. So again, please, and I can share these slides also. If you guys have any questions on that, let me know. But your client's pay is also being increased too to keep up with that inflation number. Now, the cost, it may be quicker than their pay increase, but just putting things in perspective, as interest rates start to come down, it may actually be more affordable to buy a house now than what it was when interest rates were super low. Let me talk to you guys about seller concessions for price reduction, and hopefully you guys can see that. Take an $800,000 home, guys, and I'm running an example at a 20% down payment. You take an interest rate of 6%, that total monthly payment would be about $3,833, and your cash to close, including closing costs, would be about $173,000. Instead of having your seller take a price reduction, let's take a look at those numbers. I'm not getting any bites because interest rates are high. Let's reduce my home, 5% to get more offers. Okay, let's take a look at that example. So a new buyer, they buy the house, right, for $760,000. Their payment drops to $3,640, and then the cash to close is $165,000 roughly, including closing costs. So that saves the buyer about $193. Great, but you're taking a $40,000 pay cut from your seller versus obviously selling at $800,000. Consider, guys, a seller buy down option. Same purchase price, $800,000, but instead of reducing your price $40,000, consider doing a seller buy down. What a buyer can use with that money, guys, is they can do a permanent buy down, which is paying points to lower their rate, or they can do a temporary buy down, and I'll show that in the next slide. Your seller is now netting way higher than if they did the 5% price reduction. So when you're going on a listing presentation, guys, stress to the client, you can get top dollar for that home, but consider offering them a seller concession to a new buyer, because that payment, guys, is substantially lower, $3,403. It saves the buyer more money, and your seller is netting more than doing a price reduction. If you have any questions on that, please let me know. What's a temporary buy down? Again, guys, this is for illustrative purposes only. The market has definitely come down in rate. This is just for illustrative purposes. You can do a 3-2-1 buy down. What a 3-2-1 buy down basically means is you take your initial interest rate. Right here, they're using a 7.5% example. The first year, that payment goes down to 4.5%. The second year goes to 5.5%, and then the third year goes to 6.5%, and then years 4 through 30 goes back to the initial rate. I get asked this question all the time. Is this an adjustable rate mortgage? Absolutely not. This is a fixed rate mortgage. You're just prepaying the interest savings up front. Well, Michael, what if interest rates drop to 4% and I'm only 2 years into my temporary buy down? That money that the seller could pay for, or you could pay for as the buyer, is actually applied towards a principal loan reduction. That money doesn't go away. When you do a permanent buy down, you pay points up front, and if you refinance before that recoupment period to lower your rate, that money goes away. With a temporary buy down, that money doesn't go away. You can also do what's called a 2-1 buy down, where basically you take a 2% lower interest rate the first year and then a 1% lower interest rate the second year. These are all ways, guys, to help your seller understand what a buyer's needs are. And as there has become a little bit less demand with the rising interest rates, these are just a way to combat that rise in rates, which we know was going to happen. We knew rates weren't going to stay at 2 or 3% forever. So this is a way to combat that. That's a very safe loan. It's not an adjustable, and you can always refinance. And I'll talk to you guys at the end what we can offer as far as refinancing goes. So here, we're about 20 minutes into this, and I appreciate everyone being on the call. Here's the housing forecast. As we go into 2023, we're going to see lower inflation. We're going to see a recession-like slowdown, meaning you're going to start to see the stock market come down. You're going to see numbers that are just going to come down because it's a lot harder to borrow money. It's more costly, and they are doing what's called quantitative tightening. They put all this money in the system, the last 2 years, and they got to just bring that money back down and hopefully drop prices back down. You're still going to see income increases to help affordability. You're still going to see very tight inventory. There's not going to be as people mainly willing to want to sell because interest rates are just, they were so low when they bought their home. But rents are going to continue to go up. With the lack of supply, lack of housing, you're going to start to see rates just slowly start to increase. So instead of that 27% appreciation that we saw year over year, we're going to start to take that back, and it's going to be more along probably about a 6 to 8%. Okay, so we got a question. How much is the 3-1 or 2-1 buy down rate average versus how much does the 3-1 or 2-1 buy down rate average versus sell? Yeah, it's a great question, Vern. So there's two different examples that we can use here, right? So example right here is the permanent buy down, right? So if they points that 12,000, they can go from a 6% rate to a 5% rate. If they decide to use $12,000 to do a temporary buy down, then what they would be looking at roughly, this is just illustrative purposes, is that would be their payment the first year, and this would be their payment the second year. So this interest rate's inflated. So a 2-1 buy down would basically give them a 2% interest rate lower their first year, 1% lower their second year. So as far as bang for the buck goes, personally, since I think interest rates are going to come down, I think the 2-1 would be the best thing to use for a seller credit versus doing a permanent buy down. Let me explain that again in layman's terms. If you offered a 12,000 seller credit today, that client could buy down their rate from 6% to 5% with that $12,000. With $12,000 that a seller would credit the buyer today, they could do a 2-1 buy down, and the payment savings is going to be about $800 less their first year and then $400 less their second year. Why I think a temporary buy down is a better solution is because I believe interest rates will come back down and they're not going to be in that loan for more than 4 years. So hopefully that makes sense. Where are mortgage rates going to go? I'm going to show you guys, just stay tuned. I'm going to show you exactly where I think interest rates are going to break. And just this is the very end, so just hang out with me. So you're going to see global quantitative tightening. You're going to see Japan. You're going to see Europe. They're going to continue to increase their rates because they have to slow down inflation. You're not going to see, the Federal Reserve buying billions of dollars in mortgage-backed securities like they were doing before. And there's just going to be more debt out there, right? I mean, people haven't changed spending habits, which is scary. And people are putting things on credit cards. With lower inflation, and as interest rates come down, you're going to see a more value for the mortgage servicing. 30-year fixed mortgages are going to move to 5% during the first half of 2023. And you're going to see that go on the 10-year yield less than 3%. When do I believe interest rates are going to drop? May 10th. And let me show you why I believe this. We talked about the consumer price index, that's at 5.7%. And these are month to month. They look at a 12-month period, but we replace the month from the year prior. So for example, right, December replaces December of 0.6. As we look at this, the consumer price index after January starts to come down. However, the shelter cost is a lagging indicator. This is a higher number. So even though this is coming down, they still they're still going to fight each other because the shelter cost is a big part of the consumer price index. When we get to May 10th, though, guys, what you can see, as we hit April, are very high inflation numbers. And I think the CPI number for shelter is going to catch up, right? That roller coaster after January is going to come down. We're going to be replacing huge numbers, guys. 0.6% in April of last year and 0.5% for shelter of last year. Mark your calendar because I believe May 10th is when we'll see interest rates probably hit anywhere from the 4 to 5% interest rate range. Take a screenshot. I'm calling it out there, but I really believe after we replace these high inflation numbers, you'll start to see interest rates significantly reduce. And again, guys, these are year over year averages. So in February of last year, we had 5.5%, 0.5%. So there's a dip here. So we'll get that inflation rating. We're going to be replacing 0.3%. So hopefully that makes sense. But May 10th is really when I believe interest rates will definitely hit their lowest levels. You can tell your clients, guys, if they buy a home today, they're going to get a complimentary no lender cost refinance. So if you're buying at today's rates at around 6%, like I said, I think interest rates are going to come down. But what's going to happen when interest rates come down? Prices are going to go up. So as so many people want to believe, I'll just wait to buy, in May, like Michael said, so is everyone else. So when you get more demand as affordability starts to come down, right? As affordability starts to get better and easier and cheaper, you're going to see more demand come into the housing market. And in springtime, I really think we're going to see a huge blow up of home prices again. So if you're a real estate agent, make sure you're prospecting, meeting with sellers, meeting with buyers right now, because I'm telling you, springtime will be a very good time to buy and sell real estate. If you can buy now and refinance later, that's going to save tens of thousands of dollars over the life of the loan. And that's why we're offering this refinance, because interest rates are inflated right now. A lot of people believe interest rates are going to come down. They can always refinance later. I really appreciate you guys taking the time to watch this. If you're on this call, please let me know. I can share with you all the slides that we went over today. If you have any questions, let me know. I really do believe now is a great time to buy real estate. I know I'm a homer, a mortgage broker, if we're saying that, it's like, of course you're going to say that. But I just want to show you these slides, guys, and put things in perspective, because I want to share this. So I really appreciate your guys' time, and have a great day.